Hello, everyone. The webinar is about to start. I see there are some participants still dialing in now, so let's wait for another 2 to 3 minutes before the webinar starts. So while we are waiting, just a few housekeeping issues to keep in mind. So during any time of the webinar, you can raise questions if you have through the chat box for a Q&A session at the end of the webinar. Last but not least, for audience in Hong Kong, if you require CPT hours, continuous professional training certificates, please get in touch with us. Please note, only fully attended participants will be issued a CPT certificate according to the regulation. So now I'm uploading. It's right here. Okay. Okay, I'm uploading the relevant press release for our rating action on two euro-denominated bonds issued by the Ministry of China is in September. So now you may find it in the chat box. So please feel free to make use of them. You can also find them on our website, www.cspi-ratings.com, and other major data platforms such as Bloomberg. Okay, welcome to today's CSPI rating credit webinar. My name is Terry. I'm based in Hong Kong, and I'm your host today. CSPI Ratings is a member of CSCI Pengyuan, one of the leading Chinese credit rating agencies with 31 years history. So today we're excited to have you to join us for the webinar, Credit Insights on China, AA, Outlook Stable. So in the past September, the Ministry of Finance of China issued two global bonds denominated in euro. It's the first batch of action since 2021. CSPI Ratings has been assigning the credit rating of AA to those two bonds. So today, our head of ratings, Dr. Larissa Wu, will walk you through the key views and considerations behind our rating actions and answer questions you may have. So without further ado, Larissa, the floor is yours.
Okay. Hello, everyone. I'm Larissa. Thanks for your interest in this webinar. Recently, CSPI Ratings has affirmed AA global scale long-term local and foreign currency issue credit rating for China. And we know China's risks and developments have always been the focus of attention. So today, I will talk about China's credit based on our summary rating method. And I will divide into 6 parts to discuss this question. In the first section, I will give you a brief rating overview for the summary rating framework and the core elements to supporting China's rating. The second to the fifth section, we will analyze their core credit factors one by one, including debt risk, the economic fundamentals, institutions, policies, and liquidity risk. The sixth section will cover the rating outlook. So let's begin with the rating overview. We can see this figure. It's the framework of our sovereign rating. So we will combine the stage of economic development and the debt burden to decide the starting credit score. For China, the per capita of GDP is $12,000. So we place it into the stage 3, and its government net debt to GDP ratio is about 51.5%. So we combine these two factors to decide China's starting credit score. Based on this score, we will consider the economic fundamentals, including the growth performance and the balance of payments performance. And we also consider the effectiveness of the institution and the policies, as well as the liquidity risk. For these factors, we will combine these factors with relevant indicators from countries at the same stage, stage 3. So we will adjust upward or downward from the starting credit score. Then we read out the indicative credit score. And we do some additional adjustment factors to got the foreign currency issue credit rating and also the local currency credit rating. So as for China, China's rating are supported by its resilient economic growth, robust external position, effective institutions and policies, and also the extremely low external liquidity risks. For these positive factors, we will upward from the starting credit score, and the rating also constrained by China's potential substantial contingent liabilities. For this negative factor, we will downward from the starting credit score. So this is the logic way how we obtain the China's rating AA. And we also want to introduce that we have provide credit rating for China since 2018. And as of now, we have assigned the global scale credit rating to 11 USD denominated and 5 euro denominated growth bonds issued by the Chinese government. So move the next part, we will analyze the core factor one by one. And the most important factor is about the debt risk. We believe that although China's debt scale is being steadily increasing, but it still remains with a reasonable range. And I think the debt risk is manageable. So for details, we can see the left figure. As the physical expansion continues, China's public debt scale continues to grow. We estimate that the debt scale in 2023 is around 120 trillion, and a broad debt ratio to GDP reaches 95%. So we believe that even the debt scale is growing, but compared to other economies, the overall debt burden is moderate. But considering the current economic transformation and the insufficient effective demand, a positive fiscal policy will be maintained, especially the issuance of the special bonds and ultra long-term bonds will be continued. So we expected that the debt scale will be rising in the future. But at the same time, we can notice that the debt structure is not very efficient. We can see the left figure. We can take 2023 for example. So we can see the red bar represents central government's debt, accounting for 25%, and the blue bar is local government direct debt, counting 34%, and the gray bar represents the contingent debt for local governments, accounting for 41%. So the central government remains at a relatively low level, but the contingent debt with the highest proportion. So it's the risk most market participants concerned, and we also apply one notch down from the starting credit score. Talk about the contingent debt. In China, the majority of contingent liabilities are held by local government financing vehicles. These companies are established and owned by local governments. Their debts are generally used in public utilities and infrastructure, so regarded as contingent liabilities of the local governments. consider this risk, even the contingent liability has the proportion. But we think since the central government maintains a relatively low level, leverage level, it still has room for central governments to optimize the debt structure. So we expect the structure of China's public debt will gradually be optimized. The central government will increase debt actively. The local governments will appropriately expand direct debt and reducing the local government's contingent liabilities. In that case, thereby reducing financing costs and enhancing the transparency of the debt management, and then reduce the debt risk. This is why the reason we see the debt risk, but one of the most important reason why we see the debt risk is manageable, is controllable. And we think one of the most important reason for increasing debt, especially the increasing in contingent liabilities, is about the fiscal imbalances. And we believe the fiscal deficit will be widen, continue to expand. We can see the left figure. The official fiscal deficit in this year is 3%. But as we estimate that the broad fiscal deficit rate is about 8.4%, which is a very high level in recent years. And we also can see the red figure. It indicates that the financial revenue and expenditure pressure on local governments is steadily increasing. So in the long term, enhancing the fiscal sustainability is really depends on the fiscal reforms to balance the financial powers and the responsibilities between the central and the local governments. Exactly, this reform has already begun to be planned, but it still takes time. And next, we will take a look at the economic fundamental. In this section, we will focus two main areas. The first one is the growth performance, and the second one is the balance of payments performance. So as for the growth performance, especially, we still need to deal with the pressure of short-term growth and the realization of the official 5% growth goal in this year remains uncertainty. So we can see the right figure. The gray line represents the fixed investments, and the blue line represents the consumption. So from this year, from the 2 quarters, the growth rate is decline trend. It results the negative wealth effects because of the property sector contraction and weakened income growth expectation, then hints the short-term growth. But we think even the uncertainty of the 5% growth goal, we compare to the global economic growth level in this year, 3.2% predicted by IMF, the Chinese economy still shows strong resilience. And at the same time, that GDP growth rate will remain between 4.5% to 5% in the future 3 years. And we also expect if we want to achieve the 5% growth goal, more policy stimulus should be introduced. And in the long term, the Chinese economy is transitioning from high-speed growth to high-quality growth. We are we're focusing on the cultivating new productivity forces, enhancing total factor productivity, and we exactly shift from investment-driven growth to technology-driven growth. Exactly, the transformation is really a long-term process, but we are pleased to see that from these two figures, we can see the proportion of the three new economies and the digital economies in GDP are steadily increasing. And I want to explain what is the three new economies. The three new economies, it means refers economic activities centered around new industries, new formats, and new business models. And these three new economies and the digital economy will serve as the new engines supporting sustainable economic growth in the future. And for economic fundamental, another aspect is about the balance payments performance. So we take the change trend of the current account supply as the core vector for long-term external sustainable development. We can look at the left figure. The line represents the current account balance. So China consistently maintained a positive current account supplies. And we estimate from 2018 to 2027, the weighted average current account balance as a percentage of GDP is 1.3%. We expect this number to be maintained in this year, supported by strong export growth in the first half of this year. Although geopolitical factors or trade protectionism may introduce uncertainties to exports, but considering China's significant position in global trade and manufacturing, we believe that China will continue to maintain a current account supplies over the next 3 years. And we also can be seen from the red figure, the sustainability of the international balance of payments also benefits from the strong international investment position. In this figure, we can see 2023, China's international investment position remains robust. And with its share of the current account payments rising to 82.3%. We anticipate that this ratio will remain at a high level until 2027, and it will likely exceed 15%. So we think China has a strong external position. It's a positive factor to supporting China's rating. We move the next part. In this part, we will discuss how certain institutions and policies effectively support China's economic growth and transformation. Firstly, as we know, China's political system determines the high efficiency of policy formulation and implementation. Currently, the core of policies aims to balance short-term growth and long-term developments. And we always maintain a prudent monetary policy and a proactive fiscal policy. As now, our policy objectives can brief include ensuring stable growth, mitigating risks, and facilitating transformation. So the objective are devised and the core lies in how to coordinate and balance. So we calculate that the weighted average, the 10-year weighted average of CPI for China is about 1.7%, and with a volatility of 0.84%. indicate that the strong effectiveness of China's monetary policy is managing inflation and price stability. And also, recently, China has introduced a series of policies that attracted much attention in the market. So I have listed these key policy measures in there. So this series policy very comprehensive and exceeded expectation with a strong focus three aspects. The first one is losing the monetary supply, such as cutting the reserve requirements ratio and interest rates. And the second one, to stabilizing the property market, such as the down payments percentage of second home purchase and cut existing mortgage laws and relax some purchase restriction, even about the repurchase the existing properties. And the third one is stabilizing, supporting the stock market, guiding the fund to inflows, injecting in liquidity. In that case, it's reducing negative wealth effects and promoting effective demand, then boost economic growth. Additionally, the political bureau meeting also called for some structural policies, such as boosting employment, support the middle and low income households, facilitating the development of the private sector, and promoting the openness. Of course, there were some risk prevention policies, such as increasing the core Tier 1 capital into large banks. Many institutions have stated that this time is different, indicating that the policy has successfully boosting confidence among residents and institutions. So we all focus whether this can be sustainable remains to be seen. So most of the participants actually has more expectation for fiscal policies. But we have noticed that the political bureau meeting also highlights the needs for counter-cyclical fiscal policy. So we think the fiscal policy will focus more on the medium and the long term to ensure sustainability and the smooth transition risks in a long cycle. So these policies, effective policies, we think we can easily verify from the faster rise in the Chinese stock market. Okay, the fifth part is about the external liquidity risk. So we believe that China has extremely low external liquidity risk because it's a major net external credit holding the largest foreign exchange reserve globally with a very low external debt burden. So we can see the left figure. The blue bar represents external debt, and the red bar represents the foreign exchange reserve. The gray bar is the net external debt. For this one, we can see China's net debt, external debt is always negative. Compared to its relatively large foreign exchange reserve, the external liquidity is enough and sufficient. And additionally, the increasing global use of renminbi will strengthen China's external financing capacity. So we believe that China has an extremely low external liquidity risk. And for the sixth part, we cover the rating outlook. The stable outlook, we give the stable outlook. It reflects our assessment that we believe that China will navigate through the economic transition period, and the institutions and the policies will continue to be quite adaptive and effective in addressing key challenges. Some factors maybe lead an upgrade of the rating. So if China achieves effective reform, improving its institutions and policies, particularly through strengthening governance, improving the division of the roles between government and markets, and enhance availability and the quality of key data, or if it achieves structural reform in boosting its economic growth while reducing financial stability risks. And also, there are some factors maybe needed to a downgrade of the rating. If the physical condition deteriorates insignificantly as a result of increasing debt burden, or if the government resorts to aggressive credit expansion to boost economic growth, which would raise financial stability risks and deepen economic sustainability. At the end, I will give a brief conclude. So we give the China's global scale AA rating. It means we expectation of very low default risk. China has a very strong capacity to fulfill its financial commitments, and such capacity has no significant vulnerability to any foreseeable events. As a brief conclusion, we have 4 points. The first one, we think China's debt structure is mainly internal debt, and the external liquidity risk is very extremely low. So, and the central government has a low leverage. It has enough room for him to reshape the internal debt, then reduce the risks. The second one is it means China, even China is in the transition period, this still shows economic resilience. And China fostering new growth engines for a long time. The third one is means China retains a strong external position in trade and manufacturing. The fourth one is China's efficient policy decisions will effectively balance short-term growth and long-term development. So this is the end of my today's presentation. So I'm happy to answer your question. If you have any question, you can tap on the chat box. I will answer. Thank you. Over to you, Terry.
Thank you, Larissa, for the presentation. Now let's move to the Q&A session. Yeah, I got the first question here. So the first question is about the stimulus package. So over the past month, the Chinese government has been rolling out a series of stimulus measures, which could lead to a quick rise in the stock market, as you mentioned, and evidently boosting market confidence. So nonetheless, to what extent do you expect the stimulus package will affect the underlying economic fundamentals and the budgetary strength of China for the longer run?
Okay, thanks for the question. As I mentioned, the series of the policies focus on the stabilizing the property and the stock market. So as we know, the house and the stocks are the most important wares of Chinese residents. So stabilize these two markets, the appreciation in stock values or stabilization of the property markets can help boost residents' confidence, then stimulate the consumption. And on the other hand, I think the recovery of the stock market facilitates financing and expansion for listed companies, so can driven the investment growth. So, uh, so the immediate stimulus effect is is effect is really effective. But for long-term sustainability, I think the fundamental issues should be solved, such as increasing household income, boosting the corporate investment confidence, and addressing weak demand need further policies. So we think the physical policies is very important. We need to expand the physical expenditure to boost the demand expansion. So, so that's my answer. Thank you.
Thanks, Larissa. Earlier in your presentation, you mentioned that so far there's no material or major sizable fiscal stimulus has been announced yet. But there are certainly a lot of expectation on the market. So do you expect there are more fiscal stimulus to be introduced in China? And if the answer is yes, could you share your anticipation about the key recipient areas and the possible format of the stimulus package, if possible?
Okay, thanks. As I mentioned that the physical policy is very important. So most of us all expect the incremental physical policies to be introduced. Because we believe that in the short term, in this year, we're achieving the 5% growth target still remains uncertainty. And the sustaining the recovery of residents and the institutions' confidence will also require the implementation of incremental physical policies. So we think the incremental physical policies is needed. But I think look at the long term, it's crucial to use physical expenditure expansion to compensate the insufficient market expansion to boost the demand growth. Um, but uh, but we believe that on one hand, for the formats, on hand, the most important, the physical expansion will primarily involve leveraging by the central governments. So central government has a relatively low leverage. So he has enough room to increase their leverage. We think the central government will increase in the issuance of the special bonds and ultra long-term bonds, and as well as along with coordinating the issuance of special bonds by local governments. On the other hand, while expanding physical policies, we will focus more on the sustainability of long-term physical. About the direction, we take more attention on the expenditure quality. For the short term, we think we'll focus on the boosting consumption, such as the trading program for consumer goods and the subsidies for low-income groups to boost the consumption. But in the long term, efforts will be directed towards cultivating the new growth engines, such as emerging industries like new energy or artificial intelligence and that. And I think another important direction is increasing transfer payments to local governments to address their fiscal threshold and resolve high-risk contingent liabilities. It's also very important. So this is my answer. Thank you, Terry.
Thank you, Larissa, for your insight. So now we're coming to the end of the webinar. If you have any other questions, you can always get in touch with CSPI Ratings or to Larissa directly through the contact information on your screen. Once again, if you need the CPT hours, the continuous professional training certificate, please get in touch with us. I would like to thank you again for participating. See you next time.
Thank you. See you next time.
Bye.
Bye.